Dividend investing is a powerful strategy for growing your wealth over time, but it's not foolproof. Choosing dividend stock alone won't ensure success. To maintain and grow your passive income, it's crucial to avoid certain common mistakes. In this video, we'll explore 3 of the biggest mistakes dividend investors make, show you how to stay clear of them, and share 3 rules to follow when investing in dividend equities. Mistake number 1. Going after high yields without assessing the fundamentals. High dividend yields can be very appealing, offering the promise of faster financial independence through substantial passive income. This can be true especially with well-established companies like Enterprise Product Partners and Enbridge in the midstream sector, or Altria and Brookfield Renewable Partners in other industries. These companies offer high yields that are supported by strong cash flows, stable business models, and investment-grade balance sheets with ample liquidity. However, a high dividend yield can also be a red flag, signaling underlying issues with the company's operating model, balance sheet, or payout ratio. For example, Lumen Technologies once had a high yield that seemed secure, but due to declining revenues and a heavily leveraged balance sheet, the company was forced to eliminate its dividend entirely. Similarly, Medical Properties Trust had to significantly cut its dividends due to financial difficulties with its major tenants and its own substantial debt. While I personally love to buy high-yield and dividend stocks, it's important to always check under the hood to determine that the dividend is truly sustainable first. Mistake number 2. Failing to diversify across companies and sectors. Another big mistake is over-relying on 1 or 2 sectors when building a dividend portfolio. Dividend stock performance can vary significantly across sectors during different business cycles. For example, during the COVID-19 outbreak, retail sector REITs, Simon Properties Group, and energy sector MLP Energy Transfer faced significant challenges and cut their dividends. However, both have since rebounded strongly, increasing their dividend payout. Because unpredictable events like COVID-19 are impossible to foresee or time, it's wise for dividend investors to diversify across various sectors and companies. This strategy helps mitigate the risk of severe dividend cuts and capital losses if such unforeseen disasters impact your portfolio. Mistake number 3. Overlooking the effect of rising interest rates. A third major mistake I've made in the past is underestimating the impact of rising interest rates on some of my stock holdings. Increasing interest rates can be a significant challenge for most dividend stocks. This is especially true for companies with capital-intensive operations, high debt levels, or those that function like bonds with stable income, which are often valued based on their yields. While long-term income-focused investors might not be overly concerned about the stock price of a bond-like dividend stock like Realty Income dropping, the risk is much higher for businesses with significant leverage or capital-intensive operations. Take Algonquin Power and Utilities as an example. Despite its strong dividend growth history, appealing yield, and strong Better Business Bureau credit rating, many investors overlook its substantial floating rate debt and significant capital needs for growth. When interest rates surge, AQN's cost of borrowing and equity financing soared, making it too expensive to issue new shares. Consequently, the company had to cut its dividend, scale back its growth plans, and now is trying to sell its renewable business. Many investors lost significant amount of their initial AQN investment. Let's look at 3 crucial rules for successful dividend investing. Investors who stick to these 3 straightforward rules can reap the benefits of dividend investing while avoiding the common mistakes. First, focus on dividend stocks with a proven track record of at least 10 years of consistent annual dividend growth. You can easily find these stocks by screening on platforms like Seeking Alpha, Yahoo Finance, and Value Line. Second, stay clear of smaller cap stocks. Even if they have a solid dividend history, these companies often face cash flow challenges, debt problems, or revenue issues that can make sustaining dividends more difficult. Last, aim for stocks with dividend yield between 4 and 5% and only consider yields up to 6% if the company has a very strong financial position. This approach helps you avoid the pitfalls of high-yield dividend investing that I mentioned earlier. And don't forget, regularly monitoring your portfolio is essential for success in dividend investing. Just like tending a garden requires pulling weeds, keeping an eye on your portfolio is vital for maintaining a strong and healthy dividend strategy. Dividend investing offers substantial rewards, especially when done thoughtfully. A simple strategy like holding a well-regarded dividend ETF, such as the Schwab US Dividend Equity ETF, SCHD, can yield strong passive income and solid returns over time. Selecting individual dividend stocks can enhance those returns even further. However, to succeed as an investor, you must avoid common errors like focusing solely on high yields while ignoring the company's fundamentals, neglecting portfolio diversification, and overlooking the effects of rising interest rates. By carefully navigating these challenges, you can build a future filled with growing, compounding income. Now that you know the mistakes to look for in dividend investing, check out my video on the absolute best dividend ETFs right here. Link also in the description. Please share your feedback with us in the comments, like, share, and subscribe to Financially Well. And until next time, stay financially savvy. We'll see you in the next video.